Now think you are riding a bike in a mountain and it started raining like crazy. Now in that dangerous situation, you need a shelter, right? An emergency fund is like that shelter. For better understanding, let me explain it to you. Hey everyone, welcome back to Finance Buddha. I'm Shashank and today we are diving into part 2 of our financial checklist, emergency fund. And trust me, it is the only financial life jacket that will protect you when life throws unexpected expenses your way. So why not? Let's break it down. So the very first question that comes to our mind, why is emergency fund so crucial? Now think of life as a cricket match. Sometimes we win, sometimes we lose. कभी हम जीतते हैं, कभी हम हारते हैं. But when an emergency situation comes in, be it a medical bill, car repair or home renovation, without having a financial safety net, you are scrambling. And that's where an emergency fund comes in, so that you don't have to pause the game. Now, speaking of unexpected turns, Finance Buddha also offers insurance coverage designed specifically for a job loss. Imagine getting 6 months of salary when you need it the most. And unfortunately, if you are one of them, you can check the link in the description for more information. It's quick, easy, and can kick in just a week after you lose your job. Now, coming back to the topic, how much money you need for your financial safety net, so-called emergency fund. It's simple. All you need to do is to follow these 5 steps. Step 1. Figure out how much money you need. You can start that by adding up your monthly expenses like rent, groceries, insurance, etc. and multiply that by 6 if you need 6 months of fund and by 12 if you need 12 months of fund. For example, let's say your monthly expenses are 50,000 rupees a month. So you can aim between 3 lakh to 6 lakhs. Sounds doable, right? Step 2. Since you have figured out how much money you need, you can start saving for your so-called emergency fund. Temporarily, you can reduce your investment if there is any to build your fund faster. For example, let's say your monthly investments used to be 20,000 rupees a month. You can cut it to 10,000 and put that extra 10,000 into your funds. Easy peasy. Step 3. Cut unnecessary expenses. Trim the fat. Skip those extra dine outs. Cancel that unused subscription. And here's a tip. Wait for 30 days before any purchase. And if you still want it, go ahead. Step 4. Add lump sums. Got any bonuses or tax refund? Put that into your emergency fund to boost it faster, because every little bit helps. Step 5. Automate your savings. Set it, forget it. Automate your transfer so that you are constantly saving without even thinking about it. Now that we have saved enough money for our fund, the biggest question is where to park it. But before we do that, we need to be mindful about 5 things. First, accessibility. Can you access your money easily whenever you need it? Second, liquidity. How fast can you convert your investment to cash? Third, interest rates. Are you earning enough to beat inflation? 4. Hidden charges. Are there any fees or penalties that could eat into your savings? 5. Security. Is your money safe? And that being said, let's explore the options that we have where we can park our money. Number 1. FD. FDs are safe with fixed interest rates and guaranteed returns. And it's perfect if you don't need the cash immediately. Number 2. High yield savings account. Want easier access? High yield savings account offer better returns than general savings account, and you can withdraw your money anytime. Number 3. Liquid mutual funds. Want higher returns but don't mind taking a little risk? Liquid mutual funds is your go-to, offering interest rate of around 9%. Number 4. Corporate bonds. If you are someone looking for a potentially higher return, then corporate bond could be an option. But be aware, there is some risk if the company struggles. To understand it better, let's take an example of liquid mutual funds and FD. Let's say investing 5 lakh rupees in a liquid mutual fund at 9% interest gets you 45,000 rupees, while an FD at 6% earns you 30,000 rupees. So it's all about balancing between what you value more, liquidity or security. Remember, Keeping all your money as cash can lose its value due to inflation. So it's smart to mix things up between FD, liquid mutual funds, high-yield savings account, and even corporate bonds. Got any thoughts or comments on these options? Drop them in the comments below. We would love to hear from you. And don't miss the next video where I'll be joined by our co-host Amisha to discuss about 50-30-20 rule. I bet you don't wanna miss it. Thanks for watching. Don't forget to like, subscribe, and hit that bell icon. Stay financially fit and see you in the next video.
Find the right loan from the right lender.